Spanish and French debt auctions disappoint, pushing yields to a fresh euro high, including those of the German equivalent. European stocks move lower, and U.S. futures reverse to the downside on results of the auction. Retail names take up most of the earnings calendar, and new home sales will be in focus today as analysts expect October to show a slowdown. Sign housing will remain a laggard. Other economic data to be released today includes jobless claims, Philadelphia manufacturing survey, and nat gas inventory. I'm Jill Malandrino, and the morning call starts right now.
Morning. I'm Marc Sperling, welcoming you to T3Live's Morning Call.
And I'm Jill Malandrino, and together we bring you the morning call. So, Mark, we had a very ugly session yesterday. It was a little bit choppy. The trading was unconstructive. It just didn't feel like there was any rhyme or reason. It was very, very, very choppy. We ended up the day significantly to the downside, around 3:30, 3:45-ish. Fitch comes in saying that there's the contagion risk because of U.S. exposure to European debt. So there's a lot going on, and we have a lot to look forward to today in terms of economic data, including new home sales, and we have options expiration tomorrow. So there's another volatile, choppy ride.
This is true. We've been in a very, very tight range, and this range seems to be working itself to the downside. At this point, we did close below the 1230, 2 level. We're opening up a little bit below there this morning. It's going to be tricky. We're coming out of that wedge, which normally means more downside is in the cards for us.
So if we take a look at the SPX, let's walk through how we traded yesterday and how we set up for another choppy day.
Every morning I come in, I sort of erase what happened the day before, because for the last 2 weeks, we've been gapped up, gapped down, and really do a whole lot of nothing during the day. We have been wedging, and you can see on the SPX right now, it's been getting tighter and tighter over the last few weeks. And I was questioning even last night whether we were going to resolve ourselves to the downside, and I would put a 5%, 10% chance, and then we're obviously down a little bit this morning, which means after you resolve yourself to out of this wedge, we should have more downside, and it should last for a little bit of time. Obviously, headline news is really what dictates everything at this point in time. So I'm looking at 1220, at least initial support, and then after that, you're looking at really 1200 as the firm support.
Okay, so fundamentally going into trading today, we have a very packed earnings calendar, which will be focused on the retail names. We have new home sales. Analysts expect October to look down, which is obviously not a good sign for the economy. We also have jobless claims and the Philly manufacturing survey and nat gas inventory data. Moving along into the trenches, speaking of energy, crude hit over 100 yesterday. Those spreads are coming in real narrow, which applies pressure to the refiners' margins. Let's take a look at Valero. Other names within that space that had some pressure, Marathon. Tesoro is another one. Valero was down 6% yesterday, and the reason is due to these spreads coming in and pressure to the margins.
Correct. You're basically, excuse me, cancel. So basically with the refiners, they really hasn't been a whole lot of action there, but you are seeing some digestion that really has happened and obviously some downside action. I still don't think it's resolving itself to the downside based on from September's move, but you got to wait and see. I mean, with oil and everything hitting 100, it's one of those things you got to really just keep on the radar over and over. And then on that front, you got to look at the OIHs accordingly. They had a chance to break out yesterday, the OIH, which is an ETF for oil, and they really came right back to its base. So I think it's just more of the same, more of back and forth action and just wait and see.
Right, so another name that had some significant pressure was Chevron, ticker CVX. There was news that there was a Brazilian oil leak, and of course that's going to put that name under a lot of pressure. Yeah,
that might have started the little drip in oil, even though it could have been isolated to obviously an oil leak, and then reports come out that the oil leak was already plugged up. It looks like it's getting right back down to its 50-day moving average, which again should find some support roughly around the 99, 80 level. Across the board, oils don't look bad in general.
Mm-hmm. So if I had to pick a space within the energy name where I might be a little bit more constructive, I would probably take a look at the diversifieds, like an ExxonMobil or ConocoPhillips. These are very cash-rich companies. They have strong dividends, although shareholders are screaming for Conoco in particular to take their dividends up. But if you don't have just the risk of refining margins, just like a Valero would, ExxonMobil, a Conoco might be a better place to go.
I couldn't agree with you more. Right now, you can just see Exxon, when we rallied a few weeks ago, Exxon was the first to go up, touched its 200-day. At this point, it's been in a tight trading range. You're looking at roughly 78 lower end of its range, 80 up end of its range, so obviously it's very tight. When it resolves itself, either to the upside or downside, I think that's the move that's going to last. So I would look at that. And also, if you want to look at COPs, kind of go same type of pattern, not as tight, but at the same time, you're looking at roughly 68 and 72 as the range for this. And when it resolves itself to one direction, I think that's the direction that's going to last. We're still in that point where we haven't resolved ourselves yet.
Okay, so we'll have to see how the oil story plays out. And we're also moving into the winter season where nat gas tends to be a little bit stronger as well. So we're not as constructive on the refiners, but we tend to go more into the diversifieds. We're going to jump into a quick commercial, and when we come back, we go into the trenches.
Hi, I'm Sean Hendelman, CEO of T3Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back to the morning call. We're going to jump into the trenches with the retail names. Now, Mark, I actually had the opportunity to meet with Dana Telsey last week at the Women on Wall Street function sponsored by Trader Magazine. And I asked her, what are you looking at for 2011 holiday? And she expects, and of course, Dana Telsey's the axe within this group, so I'm really excited to have the opportunity to speak with her. But she's looking at a very strong, aggressive, planned promotional season going to Black Friday. And her top 3 picks is Macy's, Limited, and DKS. So let's kick it off and take a look at Macy's.
Macy's, to me, it's something I do not trade very often, but from a technical point of view, this is the daily chart. You're looking at a very tight pattern in the upper third of its trading range. As long as it stays roughly above 29.50, 230, I think it's okay. And I do think, with how the market's trading, if we can actually sustain some stability here, you should probably make, Macy's looks like it's going to make new highs. Okay,
moving along to Limited, and they are definitely a big contributor to my wardrobe.
Limited, same type of thing, not as pretty in my opinion. Really, has done a whole lot of nothing for the last month and a half, and not as exciting to me, but it's still hanging above its 21-day moving average, which is important. I would look for this stock to stay above 22 and possibly work itself to a new high back to 46, but not looking too much into it at this point.
Okay, and moving along to 2 names I don't like. Abercrombie & Fitch, they got slammed yesterday. Investors were not happy with their comments on the conference call. And the second one being Gap. I haven't liked them really ever. They're my Bank of America of the retail sector, but there hasn't been a trend there or any sort of product mix since the ugly 2004, 2005 skinny jean craze.
Abercrombie & Fitch, the gig is up, as you say. It's done. It's been done. It gapped down 2 weeks ago. It lost 30% of its value. And then in earnings, it lost another, 17, 18% of its value. And at this point, it just needs a lot of work to really get to a little nice solid base for it to obviously try to, propel itself up. Avoid right now anything it's short on rallies for the time being.
And how about Gap? Is there any hope there?
Gap has been the, stepchild of retail for a while right now. It really has not done a whole lot. And, granted, the chart doesn't look that bad. If it comes back in its gap, above 21, it looks like about 20.50. I think you have a shot to get to maybe 23. But overall, not very excitable. I'd look to short roughly against the gap, which is roughly 21, 20.50. Probably a move down to 17 would be in the cards, especially with the slow retail, possibly slow Christmas quarter.
And rounding it off with Costco, technically this one looks pretty good. It looks like it's near its highs, actually. Oh, close.
Costco's good. I mean, talk about tight. It has been in a $3 range for, you're talking about almost 6 weeks. Top third of its trading range, that's what I like to see. I like to see stocks that have built nice bases over a period of time, resting, digesting, and obviously any sort of catalyst type of news to the upside or downside should propel it one way or another. In my opinion, it looks good based on what market conditions are doing. And I would look lower end of the range, 82, top end of the range, 86. Play it accordingly. Obviously, I'm not just chasing new highs at this point.
Well, the retail names are definitely going to be in focus, not only because we're coming into Black Friday, but oil prices. How is that going to defend consumer spend? How is that going to affect consumer spending habits? So, there'll be a lot of trading opportunities in here, even though from a macro perspective, the market's been trading off of headlines. There always is an opportunity, and I think we could get in with some fun plays with the trading ranges and the retail names. Moving along to quick hits for some quick cash, we're going to look at the semi space. So let's review the ETF before we jump into some individual names.
The SMH, if this market can get out of its own way, right now I'm not so sure it can. The headline news seems to be too strong. SMH, one of the strongest sectors we have out there. The names accordingly, you know, Intel, Qualcomm, Cisco, names that if you haven't been in this trading business for longer than 5 years, you might have never heard of them. And it looks good. It looks like it's a sector to go to when we finally find some support.
Right. In fact, for our options profits play on Tuesday, we did KLAC, KLAC, which is just not a radio station out on the West Coast, but you know, we're looking for a little bit of a pullback to get involved here, but fundamentally we like it long term. So there's a couple different ways that we could play this name.
Yes, you know, it's one of those things you don't want to just buy at new highs. You want to wait for pullbacks of the best stocks, and you want to wait till they either touch key moving averages in order for us to get involved. And I think KLAC's one of those names. As I was saying, Intel's probably one of those names also. You want a nice 2%, 3% pullback possibly. So you're looking at KLAC. I'd like to see this get down to around 45 level. I'd obviously look to get involved. It seems like it's in the right sector. It seems like it's the right name with a little digestion. It looks like it's the right play to obviously, you know, move forward as this market.
And speaking of Intel, let's take a look at that chart too, because I've heard people more bullish on it, more so than they have been lately. But is it getting a little bit toppy here?
Well, you know, I always get a little skeptical when Warren Buffett goes in and buys Intel when he's never in a tech name. After the run it just had, it obviously just moved from 20, really actually 19 all the way to 25. I think it needs a little digestion, but at the same time, these names that we have not traded at all in the last 5 to 7 years are all of a sudden come back in play. Doesn't make me a little skeptical, makes me a little excited. You just got to keep them on the radar for sure, but only on pullbacks would I be getting involved in Intel.
Right. Another one too, Texas Instruments, ticker TXN. That looks like it's stuck with between the $30 and $32 range.
Talk about boring if you're actually trying to trade this every single day. But at the same time, it's a semi. It's not an exciting name, but 30, 29.80, lower end of its range, and 32, upper end of its range. So if you're going to be taking a position in one of these stocks, look to take a small position, tier 1, tier 2, at the 29.50, 30 level. Look to be getting out of some above the, you know, around 32. And if it obviously eventually goes through with you know, some push in this market, then you can add accordingly.
Okay, well, we have to take a look at Apple because it wouldn't be a morning call with us if we did not take a look at that.
Scott's
favorite.
sitting in
We're
Vegas.
thinking of you.
He's sleeping probably at this point in time, but we know he likes his Apple. Right now, Apple to me, chart doesn't look the best. We know it's a go-to stock from a trading point of view. It should hold. It seems like 378 has been buyable. 380, 390 looks like it's sellable. Play that range. Still $9, folks. That's enough for us to really get involved. Until that point, there is a chance that it could hit its 200-day move, or I think is that the 200-day? Let's say 365. Yeah, the 200-day moving average at 365. But at the same token, if we see some support in this market, they're going to go after Apple. And with strong retailers, you know, with strong retail, Christmas coming up, what is everybody going to get? An Apple product.
Okay, and let's round it off with Amazon. This name has just gotten completely beat up following its earnings. And the key theme that Scott and I have had all earnings season is if you don't have a great quarter and you're not delivering super strong, clear guidance, your stock's going to get smacked around. And Amazon has just had a really tough time recovering from that because they blew the quarter and their guidance wasn't spectacular by any stretch.
Well, that's what you have to worry about. You have to worry about when you have a high beta stock, huge growth, everybody's in it, and all of a sudden it disappoints on its quarter. I am not that concerned from a fundamental point of view what Amazon's doing, even though, again, it didn't have a great quarter. I think it needs a little bit more time basing in this area. I'd like to see it base above 200. So that means it could get at 200, which would be, again, the 200-day moving average. A little bit more basing. I don't necessarily think it's getting there, but that's something that could be in the cards. A little bit more basing is going to be a go-to stock for next year.
All right, so for quick hits, we're taking a look at the semi sector, which has quietly been performing well. And those are always fun names to trade, especially for those of us who have been in the business a little bit longer than 5 years, as much as I hate to admit that. And of course, it wouldn't be trading day unless we took a look at Apple and Amazon. So to round out our call for today, look, we always say stick to your trading plan, stick to your rules, be nimble, be quick, manage your position size because this market is choppy, it's aggressive, it's been relatively unconstructive, and we're heading into options expiration tomorrow. So there's a lot to set up for going into trade the next 2 days.
You certainly have to be flexible. This is one of the most frustrating trading tapes I've seen in a long time. I've been doing this for probably about 13 years, and every day it has no memory as to what happened the next day. And that from an experience point of view is very frustrating, because you bank on, this should happen, or this is what should, how it should play out. None of that is happening right now. And obviously, part of that is a lot of the indecision that's happening overseas and all the headline news.
Okay, all right. Well, the best thing that we can tell you is buckle up, keep your positions nice and tight, be nimble, keep your emotions in check. Have a great rest of the week. I'm Jill Malandrino, and that's your morning call.